to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Nice to be here on a dreary Saturday morning. Hopefully this weather clears out relatively quickly. But, hey, I want to just start off by reminding anybody that wants to sign up, there's a tax avoidance workshop. That's a seminar we're having Saturday, July 14th, 8:30, Cleveland Corporate College. Go to bullingtoncapital.com to sign up online. No cost to attend. We're going to be looking at a couple different things. Tax advantage portfolios from Russell Investments. That's a, if you don't recognize them, they're one of the more popular indexers, are research firms that also manages money and consults with trillions of dollars in assets over the world. And they've got, by the way, a lot of these strategies that we're going to be talking about, you have to be that big to be able to make them work. When you're not as large as they are, there are things that they can do that you can't, and it puts you at a big disadvantage. So we're going to be talking about that. We're also going to be talking about an investment-only annuity. Investment-only annuity. They're the least expensive annuities in the marketplace. And I'm actually pulling out the one that actually has the lowest expense ratios to kind of show you. So if you have an annuity out there, you're wondering if maybe you might be able to do a little bit better, you might want to come and find out more about that. There are over 300 institutional funds inside of that product. Works kind of like a 401k, except that you don't get to write it off in the year that you make the contribution. You also don't have to pay taxes on it when you take money out of it, and it does grow tax deferred. I'm sorry, you do have to pay taxes. That was a Roth IRA. You don't have to pay taxes when you take it out. I'm rambling on. Anyway, you have to take taxes when you take it out, but you don't have to pay tax on the entire thing. There's some differences between this and other types of tax-deferred investments. And we're going to be talking about that in great detail because the 300 institutional funds that are available in there from all the major fund families, except that when you invest in the funds through this product, their expense ratio is lower because these are institutional funds. They're not retail funds. When you buy a fund directly from a fund family, any of the major fund families, they have, many of them, if they're big enough, I should say, they have multiple classes. So they've got classes that the retail investors, that would be somebody that just walks in off the street or calls or gets on the internet. And then they have the rates that they charge institutional investors, which are significantly lower. Well, in this product, they have the institutional funds. So the expense ratios are very, very low. Like I said, if you've got a product, you're not real happy with the performance, you may want to take a look at this. One of the other good things about it is, let's say you have taxable investments. If you're getting capital gains and dividends and you're having to pay taxes on that, you can actually defer that and not have to pay that. And you don't even get a 1099 in most years if you're not taking any money out. That can be a really beneficial thing. Also, you don't, if you're in your 70s and you're required to take out required minimum distributions, it's something that, and you have taxable investments. Well, if the taxable investments are producing income and dividends and capital gains, and they're inside of the investment-only annuity just for the tax deferral, well, that goes away and can reduce the amount of taxes you have to pay on your required minimum distributions. So, we're going to look at all that stuff. I think it's a great idea. It's a great time to be doing some of this stuff. And again, you can just sign up for that workshop going to bullingtoncapital.com and click on the seminars tab there, and it'll take you right there. There's no cost to attend. Seating is limited. It is on a Saturday morning at 8:30, so we'll get you in, get you out pretty quickly. I actually have to be here to do the radio show at 11, so can't talk too long. And a lot of good stuff. A lot of good stuff that we'll be covering there. Those are the two biggest, the two main ideas. We'll probably talk a little bit about some of the other things that we're doing at Bullington Capital. One of the things being I just sent out our first couple of emails that we're going to be sending more frequently. So I signed up for a service that allows me to select articles that I find interesting from multiple publications all over the world, actually. And when I find those that are interesting, I'm able to select them and include them in an email. Now that's a kind of a big deal, because if you don't have permission to reuse this material, you can get in big trouble. So I decided to spend the money to go with this service that allows us to use this material without getting in trouble, and we'll be putting out a weekly email. So you can actually go to my website and sign up for that if you'd like to. One of them was, one of the articles I found was really interesting, was Walking the Tightrope of Money Communications. That's a big one. I don't know how many of you know, but when you're an investment advisor, you also get to play marriage counselor many times. And psychologist. Yeah, there's a lot of stuff that we have to talk about because money is a very emotional topic for some people. And I'd say for a large percentage of the population. And trying to get the most out of your conversations with your significant others really, really helps, especially if you do that before you commit to long-term relationships. Anyway, there was a really interesting article there. So again, if you hear anything here or you didn't get a copy of that, let me know. I'll be glad to send you another copy of it. And there were some other things in there that I found interesting. I had somebody respond to one of the articles, and it was talking about the fact that the tax cuts that my mind is going completely blank. I mean, the tax cuts were going to lead to a recession, and that Trump was going to be the blame for it. Well, he did spearhead the tax cuts, but you got Congress and Senate that had to approve that to get it passed. And you know what? The fact that there's going to be a recession is indisputable, because it's just like saying, the seasons are going to change. That's part of the way the world works, especially in an economy like ours, and most economies, actually. So recession is just saying like, hey, there's going to be another time period where there's going to be, 6 inches of snow on the ground. Yeah. Can you tell me exactly which day that's going to happen, please? You know it's coming. So that's why you have preparations. You have snow boots, heavier coats, hats. That's why when you're in the stock market and you know there are going to be recessions, you have things like money market and short-term bonds. They're to prepare for these things because we know they're going to happen. It's not a matter of if they're going to happen. And they're going to happen. Will the tax cuts lead to that? No, not initially. Tax cuts lead to expansion generally. And to be able to figure out exactly when that's going to happen, very difficult. When I say very difficult, what I mean is, the difficulty of maybe the Browns going undefeated next year. That's the level of difficulty. Is it possible? Yes, it is possible. Is it probable? No. Not probable. So to be able to know exactly when, to be able to and by the way, somebody will say, well, that so-and-so and so-and-so published an article. And then you go look at the article and you realize they published it after the fact, 9 out of 10 times. And the few times that somebody actually decided to make that call, it's it's just luck, because you've got hundreds of thousands of advisors making those calls. They're not real advisors, by the way, because real advisors don't try to predict the market. These guys are fake advisors. They're trying to sell newsletters, fake news, and courses for thousands of dollars. And they can convince you. And if one of them gets lucky, by the way, and one of them will, incidentally, there are so many of these things that somebody's going to get lucky. So anyway, I wouldn't pay a lot of attention to that. What I would pay attention to is that the job growth and the unemployment numbers are the best that they've ever been. What I would pay attention to is housing sales are doing well. What I'd also pay attention to are car sales. They've done very well. They actually peaked a couple of years ago, haven't dropped off very much. That's amazing. That's a really good thing. In fact, when I was back, this is back a few decades ago now. I'm embarrassed to say that. Almost. A few decades, they taught us that the inflation rate of 6% was utopia, not inflation rate, I'm sorry, the unemployment rate of 6% was utopian and could not be sustained for any length of time. That was a utopian dream and would never happen. Well, we've been below that level for an extremely long time period. Now, they also have changed the way they count the unemployment numbers. But that being said, even with the adjustments, we've been at 6% or below for an unbelievably long time period. And they literally taught that that was impossible. So, and there's nothing wrong with that. I mean, you learn as you go. At that point in time, with the data that they had, that was a reasonable assumption to make. But, things change. They change. Staying in tune to the change. That's kind of key. There are lots of things that investment strategies that used to work that really don't even exist anymore. They just don't even exist. And there are new ones. There are new opportunities. When I look around, I see how valuations are on stocks. Are they a little bit high? Yeah, a little bit. Not a lot. When you look at the economic growth that we're experiencing, the growth in sales in these in the top 1,000 companies in the world, it's a very positive thing. So the valuations are, when you look at that in that context, they're very reasonable. So the last time valuations were this high was a long time ago, and that was pretty spooky because we didn't have a lot of things that we have today. So I guess everything in its time and everything in context to the things around it. So anyway, we'll be talking about a lot of these topics at the workshop. Again, I have to go back to my website to find out which date that was. Yep, there it is, July 14th. That's a Saturday morning. You can just go online to Bullington Capital, sign up for free, or you can call us 330-664-0700. 334-660-700, and you can sign up for that. So I think this is going to be a really good workshop. I'm really excited about a lot of the stuff I see happening. I used to talk about electric cars a lot, and that was 5-6 years ago. If you think back to 5 or 6 years ago, most of you probably don't remember just because of the way the human mind functions, but there was only one real major car manufacturer that was doing that. It was Tesla. And everybody thought it was a fad. And now there are lots of electric car manufacturers, and everybody's got plans to make an electric car. And not that that's all that big of a deal. It's just what that means is that there's just an increase in demand for the products that go into those cars. So, and oftentimes I'll get people asking me, well, which stock is going to benefit the most? As if anybody could actually know the answer to that question. And I know they ask it because they're hoping to get lucky and get really rich on one stock. That's a tough thing to do. When I say tough, again, it's like the Browns going undefeated. In this case, 3 years in a row. To figure out which company is going to benefit, it doesn't really work like that. So the way that it actually works is that when a company has a technology that comes out and changes things, kind of the way Qualcomm changed the cell phone industry. Before Qualcomm came around, we were still calling phones, the cell phones, car phones. Qualcomm was the one that really made the cell phone what it is today, where you can do the texting, you can do video, you can, FaceTime, all that kind of stuff. Watching YouTube videos. I mean, I get here a little bit early today. I'm watching YouTube videos in my car. And Qualcomm was the company that made that happen. Now, Qualcomm benefited tremendously from that, but so did all the cell phone carriers. So did the companies that make the plastic that goes into those phones. So did the companies that make the semiconductors that aren't part of the Qualcomm family of products. So the ancillary products. So there are thousands of industries that were affected positively by that. And that's that's the cool thing about this. This is how it really works. Yeah, some companies get a slightly bigger piece of the pie when there's a growth in an industry, but the reality is it benefits almost all companies because the people that work for those companies and the people that make products that go along with those companies outnumber those companies tremendously. There are way more suppliers to GM than there are GMs. There's only one GM. But you've got literally thousands of people that supply them parts that go into the cars. And that's the beautiful thing about this. When you have a technology that's being released like an electric car, there's not one company that's actually going to benefit at the expense of everybody else. They're all going to benefit. Seat manufacturers, the people that make the computer components for these cars. These cars today, they're not really cars. They're computers on wheels. That's what they are. They are computers on wheels. You've got engines. Yeah, that's right. But each one, and a lot of the engines are now computer controlled. Do you know how big of a growth that's been for the semiconductor industry? The entire industry. It's not one or two companies. It's the entire industry. That's the good news. You don't have to be that right. You don't have to be perfect. You just be kind of in the neighborhood. It's like playing horseshoes, close counts, close scores. You don't have to hit a ringer every time. And inside of the funds that you're holding, you're going to get those ringers. They're going to be there. They're going to be present. They're going to contribute to your prosperity. So when you're thinking in terms of how do I maximize my returns, instead of trying to concentrate the portfolio into one or two companies and get rich on those, that is incredibly risky. And I've seen so many people that have come to me that were so successful for so long, and then one day those stocks crashed. And they are so upset. They're beside themselves. And they probably wouldn't have made the big returns had they not concentrated in that, but they also would not have suffered the losses. And I don't know what's more cruel. Actually, I have a pretty good idea that it's actually a lot crueler to make a big investment in a company and then to lose it than it is to miss that investment to begin with. So anyway, I hear the music. I got to take a real quick commercial break. This is Bill Bullington right here on 1420 The Answer. I'll be right back.
So many times to see a full moon shine. The day is done.
And we're back. Hey, feel free to call us, 216-901-0945, 216-901-0945 if you'd like to. If you've got any questions regarding personal finance, investments. Now, feel free to go to my website, sign up for the seminar coming up, the 14th of July, Saturday morning, bright and early. We'll be talking about ways to save money on taxes through your investing. You know, always an interesting topic. Yeah, you know, I really didn't like that funds that tried to do that in the past. Well, they did it at the expense of returns, and then their volatility was actually a little higher. So see, that to me didn't make a whole lot of sense. You're going to take higher risk. You're going to get lower returns. Yeah, no. Not interested in that. Now, risk is a key topic, incidentally. You take too much risk, you're going to be upset one day because taking risk is exactly what the phrase implies. You're taking risk when risk has an upside and a downside. So my riskier portfolios have a lot more fluctuation. They fluctuate a lot more. A lot of people think that I'm going to take high risk, but I'm going to avoid the downside. No, you won't. That's the other part of risk. You always hear that it's a two-sided sword. That's absolutely true. And you don't really need to take that much risk to reach your goals. If your goal is to outperform the S&P 500, by the way, you're going to have to take a lot of risk. I mean, a lot of risk. Because the S&P 500 is a risky fund. peak to trough decline was 57% last correction. Think about that for a second. 57%. That's a lot. That's a lot. And there's nobody that beat it by jumping out and getting back in. It just doesn't work. I don't care what the ads say on the internet. There's a lot of fake news out there. So if you want to do better, like let's say, we were talking a little bit earlier in today's show about the semiconductors and the semiconductor industry. Well, I've got a little model that's got 5 different funds to hit every sector of that industry so that we can participate in that. And you can concentrate that. If you're a client of mine, you call me and say, hey, I heard you say this on the radio, or I responded to the email that you sent me. And yes, I would like to include that in my portfolio. Okay, we can do that. And it has had a lot better returns than the S&P 500. Like not a little bit, a lot. It's also been more volatile than the S&P 500. In other words, when the S&P was down 57%, it was down more. But that doesn't mean you just avoid it. Oh, no, I don't want to do that. No. The way to manage the risk in your portfolio is to limit your exposure. Don't put everything you have in that one industry. That's nuts. Don't put everything you have in the S&P 500. By the way, Vanguard, this is really interesting. My trader, compliance guy, computer guy, we all wear a lot of hats at Bullington Capital because there's only 4 of us there. But he gives me an article that he found where Vanguard is removing the S&P 500 from their employees' 401k. Think about that for a second. Why would Vanguard, the leader, the fund or the firm that founded and created the first S&P index fund, why would they take it away from their own employees? They're telling you something. They've probably been listening to my show. And they're saying, yeah, that's way too much risk. We can't subject our employees. I can't even speak today. We can't subject our employees to that kind of risk. They're taking it away. They've also heard that putting more money in Microsoft when it was $400 billion than you did when it was only $4 billion was kind of foolish in the long run. It's hurt the performance and it's made the fund riskier. Okay. So risk, how do you control that risk? Well, you control the risk by limiting the amount that you're investing in those categories. So if you can't stand to be down 50% or more, don't put 100% of your money in stock. If you want to have a return, you want to have a chance at a return that's higher than the S&P 500, you're probably going to have to be 100% in stock. And you're probably going to have to concentrate the portfolio into like overweight a couple of the industries that you feel like are going to do very well. Okay, so that's how you would try to outperform. And I know a lot of this probably seems pretty difficult to understand. That's why we offer free consultations. You can come in and I can show you what I'm talking about. I can show you on my computer. Very difficult to show you on the radio. Now, I have been told I have the perfect face for radio. I'm not sure how to take that. Just kidding. Well, no, actually not. But anyway, you can call us and have we can show you what we're talking about. We've got software now, and we can put in your holdings and show you what the big decline would have been in 2007 through 2009. We call it stress testing. That's something that you have to come into the office for. That's not something I can do over the phone. So anyway, but it doesn't take very long. You can send me your holdings and I can put them in there and have it ready so that when you come in and you can see and ask questions. So it's very interesting. I think this whole dynamic, how much risk do you really want to take? How much risk do you really want to take? And, I was looking at something that was put out by one of the firms I have a lot of respect for. And statistically, mathematically, it's correct. Statistically and mathematically, it's correct. It's also very misleading. I'm going to give them the benefit of the doubt. Okay, I'm just going to say, they're just going by the book, and they're not really realizing how people are interpreting the data that they're putting out there. Because if you look at the data, it showed that the standard fluctuation, they didn't even say standard deviation, they said standard fluctuation, was 13.9%. And I can tell you that the average person reading that thinks that what they just said is the worst you can go down is 13.9%. That was the translation. That is not what they said. That's not what they said. But me being in the field, talking directly to people out in the field, those guys not being in the field, and they are talking to people like me who know the math and understand the language, they're kind of missing, or the message is being missed on the ultimate audience, which is the general public. So when you say, you can only be down 13% and then somebody's down 50, they're a little upset. If you think you're only going to be down 13% and you're down 50, yes, you're going to be upset. And incidentally, I lose a lot of business over that because somebody else will tell them, somebody else that doesn't understand the language goes, yeah, that's right. You're rarely will you ever be down 50%. Really? How about twice in one 10-year time period? It happened in 2000 through 2003, and it happened 2007 through 2009. By the way, those declines lasted more than a year. First one was 3 years. 3 years in a row, markets dropping. But mathematically, if you look at mathematically, because of the way that they measure the risk, it's set up on a calendar basis. First of all, somebody forgot to tell the stock market it's supposed to begin and end all of its cycles in 1 year. It does not know you're supposed to do that. The other thing they don't do is they don't measure the peak to trough decline. They measure the volatility from year to year, 1 year to the next year. That is again, it's not a good thing. So when you see that data out there and you see a stock fund that says, risk is only 13%. Nah, you need to multiply that by about 3. That's the real risk. 42%, maybe even by 4. Because the market had a peak to trough decline twice. It was down more than 50% inside of one 10-year time period. But it's all about the way that they frame the information, how they're explaining the information. And quite frankly, you have to be a math major nearly to be able to understand what it is they're saying. And then when you do understand what they're saying, you go, oh, wait a minute, that is really understating the risk. You're really understating the risk. So I'm going to do everything I can to try to bring everybody up to speed. We're going to talk about this at every workshop because even in the tax deferred investments, the investment only annuities, ones that I think are the greatest things since they invented tax deferral. Even in those things, you need to be aware that there's risk in there, and you can purchase riders, these things that guarantee principal and whatnot. There's a cost to that. The cost is relatively high, but it still doesn't eliminate all of the risk. So that's basically what my career has been kind of aimed towards, is getting out good information about what kind of risk you're really taking. Even back in the days when buying breakouts used to work really well, risk control was one of the reasons that you would actually succeed doing that. It's controlling the amount of risk you're taking. As you get older and you're starting to take money out of your portfolio to supplement your income, risk control means everything. You put all your money in the S&P 500 and start taking out over 5% a year or even 5% a year. You could be looking for a job in your mid-80s. Think about that for a second. Another thing is, this is a big one. Everybody looks and compares themselves to the S&P 500. Why would you do that? Why would you do that? I know why you do it, because you don't know any better. You don't want to compare yourself to the S&P 500. You want to compare yourself to an appropriate benchmark. If you've got money in bonds, look at the aggregate bond index. Okay. If you've got money, if you're a 60-40 blend, you have 60% of your money in stocks, 40% of your money in bonds, look at the aggregate bond index and then look at the S&P. And if you're not 100% large cap stock, then you need to look at the S&P 500, the 600 or the 400, because those are other categories. Comparing yourself, that's like comparing apples to oranges. They're not the same. Or apples to oranges to bananas. Not the same. But you know what? If you chop them up and put them in a salad, that tastes pretty good. And you don't get bored. My analogies are getting really bad, aren't they? Anyway, you want to make sure that you know what you're doing. Bonds are not as volatile as stocks are. Bonds are down this year. All of them are down 2, 3, 4%. Not a big deal, especially those types of bonds. They'll end up bouncing back at some point in time. Stocks, on the other hand, we haven't had a 10% drop now in quite a while, and could come anytime. Don't know if it will or not. I do know it will come. I just don't know when. And maybe a little bit more than that. It's been a really long time since we had a 15 to 20% drop, and historically that's been every 18 to 24 months, somewhere around there. So we're getting close to that. Does that mean it's going to happen, or I'm trying to get ready for it now or anticipate it? Yeah, I'm always anticipating. And I know exactly what I'm going to do if that happens. So I have a plan. If and when that happens, and it's not if it happens, it's when that happens, we've got a plan. We know what we're going to do. And all my clients have a plan. Some of them are different than others, but we know what we're going to do. And myself personally, I'm going to take the money that I've been stashing into the fixed income account, which is over the past year or so, I've been making all my additions and contributions to the fixed income. I'm trying to build that up. I'm leaving the stocks alone. When we get that correction, I'm going to move some of that money in fixed income over to stocks. So some of the money I've been accumulating in the short-term mortgage-backed securities, some of the senior loans and the high-yield bonds, I'm going to take some of that money out of there, and I'm going to put it in the stock portfolios. And there are 2 portfolios in particular that I'm going to add to. I'm going to overweight. So I will talk about those, and I'll show those to you at that upcoming seminar, or if you want to come in the office for a meeting. There are 2 portfolios I really, really like a lot. They're my favorite. They're my favorite portfolios. I have everything else that I've ever talked about on this show. I have everything else that anybody of my clients have invested in. Yeah, and I feel kind of obligated to do that. I think if I wouldn't invest in it, how could I expect you to? So, and I will tell you, though, that I've overweighted a couple of them because I like them. I like them the best. They match my personality. I'm comfortable with the amount of risk that I'm taking. And I know what I'm going to do the next time the market corrects with those. So I'm going to add to them. So I'm going to keep those secret up until the seminar. No, or until you come into the office and sit down and kind of talk about it. But, that all these years, all of this stuff is nowhere near as complicated as people would like to make it. Where it gets complicated, or where it can get complicated, is when people try to get too close. They try to know exactly what's going to happen. That would be a great thing if we could do that. Wouldn't it be great if you could do that in your entire life? You knew exactly how your wife was going to react every time you said something. That would be awesome. Or anybody. You'd know exactly how your kids are going to react, exactly what they're going to do. You know exactly what kind of money you're going to make, what kind of vacation you're going to take. There were no surprises. Wouldn't that be awesome? That would be great. Unfortunately, real life, you get surprised all the time. And investing is really, it's one of the most surprising things. So if you're going to be successful, you've got to have a long-term outlook. You've got to have a philosophy. What am I going to do? Am I going to have a super spread out portfolio, diversify, try to hit all the major categories, try to rebalance between stock and bonds? That's actually a pretty good one. Or am I going to try to concentrate and go for a little extra gusto? We'll talk about that last sentence right after these commercial messages.
When the mountains look so big and my faith just seems so small.
And we're back. By the way, you can call us 216-901-0945, 216-901-0945. You can go to Bullington Capital, sign up for that seminar, or call me, and I'll be glad to have a conversation with you, hear anything that's interesting to you. Right now I'm going to go to the phones, and I got Gerry. Gerry, how you doing?
Hi, good morning, William.
How are you?
Several things. One, with the latest news about GM and the automated driving company that invested $1.5 billion into it, you feel any more favorably inclined to it?
To GM?
General Motors, yes, sir.
Well, you know what, Gerry? I really don't invest in companies like GM unless they're part of one of my models. If it gets if it meets the criteria GM could be in could actually get into the high dividend model. It's been in there before. So that could happen, but its share price would actually have to drop from here fairly significantly to make it into that model. And it could end up being in the one of the value models that I run. But if it doesn't meet the criteria, then I don't hold it. And currently, I don't believe I'm holding it. I'd have to go back and double check because I have about 150 stocks in all the models, and they change fairly frequently. So,
I know you like the stocks that have some growth potential. GM's a big company, but another company put $1.5 billion for the self-driving vehicles. That definitely could be a game changer.
Well, I think that whole industry is changing, dramatic change. You know, GM and Honda just hooked up to develop the next generation battery systems. There's a pretty good chance that when they get it designed, I doubt that they even try to make their own. They'll probably buy a lot of them from Tesla. Tesla's going to have a huge margin advantage over a lot of the other battery manufacturers. So, but you never know. I mean, that could change, and maybe they do build their own batteries. I don't know, but I know they are moving in the direction of electric cars. They're all moving in the direction of electric cars.
Sure.
And at some point in time, watch what happens. At some point in time, there are two potential super disruptive technologies that people are putting billions of dollars into. First of all, the solar cells, the solar panels are much, much, much more effective than they were 15 years ago. And I remember back when I was in high school, Timex was selling a computer, a home computer that you hooked into your television, and it had a plastic keyboard that you pushed, was sensitive. There weren't actually keys.
Sure.
I mean, it was crazy. You actually had to get this little device, plug it into your television, and then it didn't even have a real keyboard. It was a piece of crap, actually. and you look at where laptops are today. The one that I'm looking at as I'm talking to you, I mean, it is mind-boggling. It's mind-boggling. Yeah. Solar panels are going to go down that same exact path. They've been making the progress. They've been making progress with wind. There's a thing, if they ever get this done, it looks like it's, well, from what I read anyway, and 30 to 40 years out, but they can generate electricity. It's very similar. Now I'm forgetting the name of it. It's very similar to nuclear, but it's not. It's not. It doesn't have the all the waste product that you have to deal with. But right now, as they continue to work on this stuff, electricity demand is outgrowing the pace of inflation. And that was what somebody was saying. I forget somebody sent me an article this week, and they're all upset because the Bitcoin miners were driving up the cost of electricity across the country. I got news for people. You know what's really driving up the cost for electricity, or the demand for electricity? Cell phones.
Yeah, I would say that makes a lot of sense. Let me ask you another one. Colgate-Palmolive has gotten a bit roughed up. Could they be going into your value model?
At some point in time, they might, if they keep if they were to keep dropping.
Not quite yet, though, huh?
I haven't seen it yet, so I'll keep running. Okay. I run those every month, by the way, because if somebody were starting at a time different than it's the beginning of the year, then they would want to use the more recent numbers for that.
Okay. I was going to say, I've been following Qualis in the last couple of weeks.
QLYS.
We spoke about it about
Yep.
6 months ago. I said watch it, and
Yeah. That one's
you had mentioned it on the
Yeah.
you had mentioned it on the show, saying you like the action on it. It's up to about 80 right now.
Well, the price action and valuations are two different things. It's I don't even have my telechart on this computer actually that I'm here in the office or the radio station with, so I can't really look at the price action. I'll tell you this though, I wouldn't put a lot of money in that stock. The revenue over the past 12 months is $242 million. It's up 20%, which is great. The market cap is $3.2 billion.
Yeah.
The price to sales ratio is almost 14. Gerry, if somebody offered you 14 times your revenues, your annual income for you to give them your job, and you don't take that money, you're not allowed to call in here anymore.
They could have it. They could have my job.
That's what I'm telling you. If somebody were to offer you 14 times what you make in a year so that they could have your job and you don't take it, you are not smart enough to be a listener to Bullington Capital Report.
Well, they're also, the price earnings now is 85. I could remember when it was less than 30.
The last one's 122. That's the reading I got right now.
They're 122. Wow, they've
Yeah.
gone. I thought it was 85, but I know it's getting to be pretty astronomical.
Yeah. So,
But-
and that's a software
as you
company
say,
because
William-
their margins are, very, very big, large profit margins, good growth. So those stocks will get overpriced. They'll get really overpriced.
Yeah. Well, as you say, William, anything can happen because it's a stock.
Yep, that's right.
There-
Anything can happen and
There
probably
could be
will.
more- There probably could be a little more action, but who knows? One last thing. I've been trying to get the contact information on this fellow that trades
Oh,
the
Waterman.
options.
Yeah, I'm sorry about that. I keep forgetting to send that out. I'm going to see if I can get him on to come on the show with me. I'm pretty sure he will. And
Okay. I've been trying to get his name. I sent an email down there. I haven't heard. So hopefully I could find out this week or so. I'd definitely like to talk. I have a fair amount of options out on this playlist. That's why I'm kind of anxious about it.
oh, did you sell calls or?
No, I've sold puts against it.
Oh, dude, cover
No, I
those.
have-
No, you got to cover those. You got to cover those quickly.
I also have a lot of stock out there. I haven't sold calls.
So you would
but I-
double the losses. You would
Why
double
not?
when you sell a put. No, don't do that. I'm telling you, that is not good. Not good.
I've made a lot.
I don't care how much money you made. You're gonna lose an unbelievable amount. You'll give it all back and then some if
Okay.
these guys run into problems.
Yeah,
And,
I'm sure.
You sound just like the guys that talked to me about Cisco, Microsoft, and Intel in the late '90s.
Oh no, yeah.
They were the same.
I certainly. Well, I watch the market every day, so I know, but it's probably a bit crazy.
Well, yeah, that is the beyond. You know, when they have that risk reward pyramid, you're like in one of the clouds above the pyramid. That's where your risk level is.
All righty, have a great day. Well,
Okay,
nice
you
talking
too.
with you.
All
Bye-bye.
right, you too. Bye bye. Yeah, whew, man, that is the wow. Talk about an unbelievable amount of risk. Holy cow. And you hope that it works out. I've seen people do things. I got a call from a guy once that put $3,000 in an option on oil right before we went to war with Iraq the first time. That $3,000 went up to $300,000. $3,000 to $300,000. And then he gave it all back. He gave it all back. And by the way, he didn't even sell the original position to get his money back. It expired worthless. I mean, I've seen just about everything you can see. That's why I'm always saying, anything can happen and probably will, because I've seen a lot of that. And man, when you own a stock that's overvalued and then you sell somebody the right to sell you that stock, you are obligated. Oop, I got a little bit of time. Hey, Larry, I only have about 60 seconds. Can I get to your question that quick?
Yeah, morning, Bill. Just want to let you know in regard to Gerry's inquiry, Joe Waterman's meetup site is Hudson Trading Company,
Oh, cool.
Hudson Trading Company, and he has meetups on Tuesday morning at 10 a.m. at the Hudson Library, and also Thursday morning at 10:30 a.m. at the Skyline Chili off of Steel Corner Road in Hudson. He's going to be on vacation, going on a fishing trip to Canada for the next week and a half, so you can contact after that time. But I've been going to talk to this guy. He's phenomenal.
Yep. Yeah, he is. Well, thanks
Yeah.
for mentioning that and bringing that up.
Sure thing. Thanks a lot. Take care.
Have a good weekend. And how much time do I have? No, 30 seconds. I'm sorry, I got a phone call here. You'll have to call me next week. I apologize. Or you can call me in the office, 330-664-0700. This is Bill Bullington with 1420 The Answer here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.